The Portland is Home team talks real estate. Whether you live here or you're on your way, Audra and Andrew Galler work hard to welcome you home. They make the whole real estate process attainable, educational, and fun. After all, it is the biggest transaction of your life. The Portland is Home team talks real estate. I'm Michelle Odell, your host. And now, Audra and Andrew Galler.
Michelle, hello.
Hi, Michelle.
Well, hello, February 1st. How about that? Hello, 2024. How about that? Oh, my God. We were trying to schedule this for January sometime, but Taylor was booked by the first week of January. I love it. Yeah, Taylor Cattell is here again. It's part 2 of Estate Planning and You. Taylor Cattell is a founding partner at Breakwater Law, whose mission is to enhance the lives of their clients by building and protecting their property and legacy. And part 1, we had a really good discussion. It was the holiday season, and we're talking about estate planning and wills and people dying. But hey, no better time to do that. So now we're in a fresh year where we're going to do part 2. A lot of the questions we had kind of left over. We didn't want the episode to go on too long. This time around, we're going to be talking about the folks that are coming from other states and moving to Oregon, all of the benefits, the pros, the cons. Taylor has plenty to say about that and relocating here. It's not as simple as, I'm moving to Oregon. We also want to talk about family companies, using limited liability companies as another tool in the toolbox, in addition to or in lieu of a trust. So that was some other things that Audra wanted to talk about. Property owners that Andrew and Audra have, they're going to need a lot of this information, particularly those that may have rental properties. Even if you just have one, there's a lot that goes on with that. So we're going to dig deep this episode. But of course, before we can do anything, it's Andrew Galler's Market Minute.
I'm ready. This is exciting. I got to say, I am in thrall to hear part 2.
Yes.
The first one was so great. For our listeners out there, if you didn't listen to part 1, please do. I think you should stop now and go listen to part 1, then pick it up now. Okay?
Good. Yeah, absolutely.
So anyways, my market minute, I'll tell you, wow, what a crazy month, January. For those of you not in the Portland metropolitan area, if you weren't living here, you missed a great opportunity to join me while I cooked up a storm. I had a storm cook-off, roasted a chicken one day, made bolognese, and that's how we suffered through the ice storm. 2024. It was a little biblical. Sadly, a lot of our friends, families, and clients had a little bit of the outside coming in through these trees coming down. So all of our thoughts go out to them. And I want to extend another invitation. We reached out to a lot of people who we were concerned about who live in tree-heavy areas, and we were able to help quite a few of them with our contractor referrals. And if anybody out there is still struggling to find anybody, please feel free. We've got arborists, general contractors to help you put your house and lives together, back together. We got some people with broken pipes. I don't want to talk about the sewage in the living room. Truly tragic and a real,
that's terrible.
Awfulness.
It really is
so,
bad.
Okay, so putting that out there, please feel free to contact us anytime. Everybody on our mailing list was already sent a survey we checked in with everyone to see how we can serve them best this year. If you're on our mailing list, we're going to, in the newsletter going out today, we'll be re-asking. And from everybody who does respond, they're going to get in a raffle to get a big box of chocolates from a local chocolatier, Creo Chocolates, which if you haven't been, you should go in the Lloyd District, Creo Chocolate, phenomenal. And if you respond to our survey, you'll be in the running to get in a box, save you a trip, and the opportunity to forget about Valentine's Day for your Valentine. And before my market minute, I want to invite everybody to be our Valentine 2024, because we love you. And we're here. Okay.
Nice.
Thank you for allowing me to plug everything I just did.
I know.
That's what your show. You can do whatever you want.
It's our show. Let's be honest.
It's
not just me. Come on.
It's y'all's show. How about that? Y'all.
Okay. Market minute. Here we go. I got to tell you, I'm going to use a term. It's not really accurate. it's not a tale of two cities, but it kind of is. Not really. What do I mean? That's crazy talk. I just wanted to say that. But really, the market's crazy right now. Interest rates have been going down since about Thanksgiving-ish, and then they bobbled up and down a little bit, and now they're trending back down. I'm sure all of you are up on the news, and you heard Jerome Powell talking doublespeak about what's happening out there. What I heard is that interest rates, the Fed is going to keep their benchmark rates consistent. They're not moving them. And it's all going to be predicated on what happens with inflation moving forward. So I think that's the big unknown. I'll tell you some statistics, and I'm not really interested in them. The last batch of buyers we've written offers for, we have found ourselves in multiple offer situations again. Some of that I think is a result of not a lot on the market. And when something good does come up, we're finding more than one person interested in it. So we're finding ourselves in multiple offer situations, and it's heating up, getting a little competitive. So here's some statistics. The amount of homes for sale right now relative to January over December, there's 11% fewer homes on the market and about 3.5 fewer than January last year. Pending sales are up 9.5% over December. Who cares? You know, we were coming off of Thanksgiving, going into Christmas. But relative to last January, there are 29% fewer pending sales. So more than December, far fewer, a third fewer than last January. What's up with that? You know, interest rates are relatively the same, but relative to the trend, them being down, I would have expected more pending sales from a year ago. However, inventory's down. So there's just not a lot to choose from. Which is it? We're going to find out as time goes on. Inventory as a whole, and again, for all of you, these numbers are different than what you'll see published because I'm looking at the closer in metropolitan Portland area, not the entire metro region. So in that regard, inventory based on pended sales, things in contract, which I find to be slightly more of a leading indicator than closed sales, are down. Inventory is down 18%. So now it's 1.8 months, and it was 2.2 months at the end of December. This January compared to last January, inventory is up 38%. So it's 1.8 months now. It was 1.3 last January. That's the short market minute. I think the market right now, I would say, is really today hyper-local. And what I mean is if you're interested in the market, let's say you're thinking of buying or selling, I really would buy sooner than later. I believe interest rates are going to continue to trend down over the year. The Zillow reports I get have switched from predicting price going down to price going up. The last few I've gotten, they're predicting an increase in the average sales price in the zip codes I monitor most closely, about 1.5% higher. If interest rates do trend down, I expect that to go up. Demand's going to go up. Everybody with firstborns, start throwing them at sellers again. If you're thinking of selling and buying, right now is a great time. And I'm going to conclude. Call me now if you want more thoughts. Wishing everybody a great February. And don't forget Valentine's Day if you observe it. Thank you so much. Andrew Galler signing off.
Thank you so much.
That was
All
great.
right. All right. So, ladies, Audra and Taylor, picking back up with relocation and everything that goes into that it's not as simple as it seems.
I was wondering what the difference is on ownership in Oregon. We spoke about coming from other states and the different types of vesting or however it's called when title puts it on paper and how the deed is prepared. Go over a little bit with us on what it is in Oregon compared to other states and if it's more unique here or if it's like 50-50 in the country.
I want to start off by saying, of course, I can't give specific legal advice to anyone. There's no client here that I can say this is a one size fits all or this is what you should do. So everything I'm going to say is just general information to ask an attorney about for your specific situation, especially when it comes to property.
Yes.
Okay, because there are so many wonky things that can be on one parcel past lot line adjustments, skeletons in the title closet. There's just a lot there. So nothing I say that's general information is always going to apply to everything in Oregon.
Okay.
That said, we talked at the beginning about the benefits and drawbacks of moving to Oregon, and the type of vesting is one of those pieces. And I want to say, first off, there are huge benefits to moving to Oregon, but not for taxes. Not for taxes. Okay. Not for that reason. They have beautiful trees that hopefully didn't fall down on your house recently. We've got wonderful weather that's becoming a little less predictable, but we still usually get snow. We, of course, have some rain. We have some sun. We have some of everything. We have great hiking. You know all the things. I mean, you don't move to Oregon without some expectation of why you're moving to Oregon. So that's all I'm going to say about the benefit of moving to Oregon, because you would know why. You either move, or if you just buy a property in Oregon, okay, acquiring any kind of property. The downsides is what comes unexpectedly. You see these beautiful trees, these wonderful hiking trails, great sense of community, all these other things. And I am not here to talk you out of buying a property in Oregon or moving to Oregon. I have a ton of clients who are here for a variety of reasons. Their kids came here and now they have grandbabies, and this is where it makes sense. Or they've been born and raised here and there's no reason to move elsewhere. Taxes be darned. So there's a lot of reasons outside of these drawbacks that I'll talk about that influence people's decisions. And I don't want to say taxes or certain aspects of how Oregon's laws work are the end all be all on a decision. It's a complicated decision. Oregon, first and foremost, different from its neighbors and different from a number of other states, is not a community property state. So that's the first big thing that people need to know when they move to Oregon. If you are coming from a community property state, Washington, California being our neighbors, of course, which are both community property states, Arizona, another place where folks go back and forth quite a bit, there are some really big benefits to community property. I'm not here to talk about family law stuff. I'm not here to talk about divorces. That's not the business I'm in. I'm really appreciative. That's not the business I'm in. There are other things related to community property. It's not all just good, just like everything else. But that's not what I'm talking about. I'm talking about what happens when you die with community property. And when you die with community property, you get a full step up in basis. So what does that mean? For those who don't know what basis is, short version, it's what you bought something for. Obviously, it's more complicated than that. But when you sell something that has appreciated, that has increased in value, you typically have to pay income tax on the difference. Of course, there are nuances and asterisks all over the place, but generally speaking, you pay capital gains tax on an appreciated asset. So when one person, typically in a long-term marriage, dies and they aren't sure necessarily what the future holds, it's a very common time to reshuffle things, to think about letting go of that big property that all the kids grew up in and downsize, maybe to a smaller home, maybe to not owning property anymore. There's a lot of different things that change. Maybe it's a financial decision. Maybe it's a maintenance decision. Maybe it's part of grief. It's hard to stay in that same home with all those memories. Whatever the other motivations around it, if you are in a property that has appreciated significantly, like almost everything in Portland, you have probably faced more appreciation than the amount that you are allowed as an individual to essentially be exempt from income tax. So if there's a full step up in basis on the death of the first spouse, essentially the surviving spouse can sell these assets that previously would have had a huge income tax consequence without paying that income tax. Long story short, it increases the flexibility of the surviving spouse. There's a huge benefit to having community property when you die, because a surviving spouse can really look at liquidating assets, creating flexibility, and reviewing things without having major income tax issues associated with those big decisions.
But that's for the...
In Oregon,
I was going to say, but...
you get a half step up in basis.
Okay, so that's for the community property states.
Yeah, so when you're in a community property state or you have community property, you get these tax advantages on the death of the first. So the issue is moving from a community property state to Oregon, which is not a community property state. Can you keep those community property benefits? And the short answer is yes, but not without some planning. So Oregon, basically, as all the other states do, have to honor the laws of the other states, right? You can't just say, well, you moved here, you've lost on all the appreciation, all the benefits of the past state. But it's on the individual to prove. So what does this look like? We call it community property tracing. You have to be able to trace it back to community property and show what's community property and what's not. So it takes some thought, it takes some planning, it takes some knowledge. It's not impossible. Sometimes it's not worth it. It really depends on the assets and the couple and their plan and are they going to keep something in a community property state? Are there other options that are maybe simpler to keep their residents somewhere else but have the family contact that they want here? You know, it becomes a more involved question. And my point of this is not that every listener is going to be a community property expert or cancel their plans to move to Oregon. It's simply to know in advance what's coming, be aware of the fact that that's a significant change, and know that we can get creative with how to work within the tax rules to try to get the best of both worlds. Not always possible, but at least you can try and have that information, and then you're armed with that knowledge when you come to Oregon or acquire property here in Oregon.
Taylor, if we're not a community property state, what are we here in Oregon?
Yeah, the technical term would be a separate property state.
Okay.
But again, there's not that many. There are differences, especially in the family law context. But the step up in basis is, and some other non-probate types of transfers in the estate planning administration world, those are the big differences. So that's the non-probate transfers gets a little bit more complex, and I think isn't really worth diving into now as much as that big picture knowledge that there is a difference and there are things we can do on the planning side if it is anticipated that you're going to have some kind of cross-pollination or have some other back and forth between community and non-community property states that we can work within. On the community property fund, the next question I would get is, if you've already moved here, is it too late? And the answer is no. We can potentially trace it depending on how many changes you've had since you've moved to Oregon. So it's not too late if you've already made the move. It is better the closer to that time of the move. But again, we can do some tracing, we can do some chasing, we can get creative, and we can try to get you some advantages if that would make a big difference for you.
Taylor, I bet there's going to be some listeners out there who are thinking, well, why is Oregon like this? Why are they not a community property state? What would your answer be?
Inertia. I think our states all have inertia and a certain culture, and Oregon has chosen not to adopt community property laws as well as many other states. So I don't know the policy behind that. I'm sure there was a lot of debate, multiple times in our legislative history, but we simply have taken a stance from a tax and from a family law perspective that separate property is the way that we're planning to stay as far as I'm aware. So I don't see this changing substantially. I've been wrong before. I don't know. I haven't chased down if there's any proposals, but I think that the energy in my world is really going on estate taxes and how to potentially get Oregon to catch up with some of the other states on hiring its exemption amount. And this is the other big surprise when people move to Oregon. The fact that all of a sudden you've got an incredibly low exemption of $1 million. And $1 million feels like a lot until you factor in retirement accounts, life insurance policies, all your investments, all your real property. And it's not just what's subject to probate, or, if you've got another joint owner, or if you've got transfer on death, a TOD account, beneficiary designation, a trust. All those things don't matter for Oregon's estate tax. Okay, all of that is included in how you value an estate for Oregon's estate tax. And it doesn't take much between a house and a life insurance policy to get over that $1 million mark. So most people that have a home or multiple homes are going to be facing Oregon estate taxes. And the real catch is, once you have anything in Oregon, you are, even a tow, even a little timeshare or a rental property or something else that's smaller, you are now putting yourself in Oregon's path for estate tax. And it's a little complicated on how Oregon taxes you, but essentially it's not just, do you have something under $1 million in Oregon? It's, do you have anything in Oregon? And if everything you have, no matter where it is over $1 million, then you're going to be filing an estate tax return in Oregon.
Would the estate tax be on your entire estate, even if it's on other places? Or would it just be a proportional amount to what you have here?
Right. So the short version and very, very high level is, if you've got, $10 million and in multiple states, or everywhere but Oregon, you've got $1 million in Oregon, or maybe we'll say just under, that's about 10% of your estate. So what happens is Oregon calculates, well, what would Oregon tax on a $10 million estate? Let's get that dollar figure. And then we'll take 10% of that tax, and that's what you pay.
Okay. This is great, because we're sort of parlaying right into the trust and what people hear, the step-up basis, which you mentioned previously today. How does that work in Oregon if they have a $1 million cap, basically, or whatever it's referred to, in the trust? Or does the trust, is that the way that clients who have over $1 million should be looking? And will the trust protect that amount to not pay the estate tax?
I'm so glad you asked, because I think that's one of the biggest pieces of misinformation out there, is that having a trust stops you from having to pay estate tax. Having a trust in the sense of a revocable living trust, a standard probate avoidance alternative to a will, although you still have a will, and that's a little bit more to talk about there. But the standard revocable living trust for a single person or a married couple does not avoid estate taxes, does not save you or change anything on the estate tax analysis. There are other types of trusts that do. Those are more complex, and those are more nuanced, but and I think beyond the scope of what we'll probably get into today. But the big piece of it is, just because you have a trust does not mean that you are tax-free. There are ways that you can build in some other tax mitigation trusts within a trust, and tax planning tools and things like that. So having a revocable trust done with an attorney who knows what they're doing with an eye towards estate taxes probably does have some tax planning tools to try to reduce the estate taxes. So but it gets a little bit complicated on taking a look at that, and absolutely talking to an attorney who works in this area regularly, they'd be able to say, your trust does or does not help you avoid estate taxes, and here's how. And often what happens is there are certain actions that the surviving spouse has to take on the death of the first spouse, and that has to happen within a few months after the death of that spouse to protect that first $1 million from estate taxes.
That's just because it's that $1 million basis that we're talking about. But if you were in, what's Washington's, for instance?
Yeah, so Washington has $2 million indexed for inflation. Okay. So it's going up every year by a bit, but there's a filing requirement over $2 million. Okay, but the thing about Washington, while they're similar in how they do this proportional tax, their tax rates are actually different. And so most people say, well, I'll just move to Washington. They have a higher exemption. And if you're under 2 million, then great. Yeah, if you're somewhere in that 1 to 2 million ballpark, then moving to Washington will, have a higher exemption, higher kind of free money without tax. But the Washington tax rate maxes out at 20%. and Oregon's tax rate maxes out at 16%. Income taxes are different. We're not talking about that. Obviously, Washington does not have income taxes. So on the whole, moving to Washington can be a really good tax deal.
Especially if you make money.
But if you have regular income or taxable income or income taxes is the focus, then Washington is there. But if you're just talking about estate taxes and what happens when I die, then there's a sweet spot where all of a sudden it changes, and Oregon's actually a better place because it has a lower tax rate.
That's interesting. So I have heard people say, don't let your parents put their home, their real estate, in their children's names, to put it into a trust, because then the children can get the house and then sell it once their parents pass away without any capital gain tax implication. Is that correct? And does that apply in Oregon?
You have that exactly right.
Okay.
That is exactly right. And absolutely what I recommend time and time again. Don't, especially now, if your parents bought the house, a year ago, or if there's an adult child who's living in the home and it will be their primary residence, already is, there's always exceptions to that rule. But on the whole, I say keep your house. And ideally, if it's got a lot of appreciation, die with your house. And for those folks who have had their house for an incredibly long period of time and the appreciation has just skyrocketed, then my advice to their kids, even if their parent is no longer able to live at home, find a way to keep it. Find a way you rent it out, keep it in the family, make sure there's a caretaker, somebody moves in, just keep an eye on it. Real estate has a lot of liabilities, of course, especially if it's empty, and depending on what part of town you're in, that can be a real hassle. So again, there's always exceptions to the rules. But going back to that basis question, you get a full step up in basis on the death of both, right? Or of the death of a single person who owns it. And so if you can get that step up in basis, it is basically no income if you sell the property soon after the date of death. It's treated as if they bought it on the date of death, or the value as of the date of death is that basis now.
Okay. And so that applies anywhere.
Right. And it goes back to the community property versus separate property. If there's two parents and they co-own that house, you're only getting a half step up in the basis on the death of the first. In a community property state, you're getting a full step up in basis on the death of the first.
Okay.
So in Oregon, to really capture your ideal, and again, this is capital gains tax, this is a type of income tax. If you're getting your ideal income tax result, it is getting that full step up in basis on the death of both parents or on the death of a single person, and selling that property afterwards. Now, if you're saying, well, income taxes versus estate taxes, right? That's somewhat of the analysis. What would the income tax be? If it hasn't appreciated all that much, but you're looking at a significant, 16% or 14% in estate taxes, then maybe it is better to sell it and pay the income taxes. But that's all CPA stuff, right? That's all just know and be aware. Go talk to your CPA before you list a property to sell. If you're an adult child going, okay, mom's in memory care, or dad needed to go just to get a little bit more assistance, doesn't want to do the yard work anymore, don't just jump to selling the property. And that kind of goes back to Andrew's Market Minute. I am anecdotally seeing a ton of people holding on to property longer and longer and longer because it is hard to get into the market now. And so maybe you're not planning to live in Portland now, but your kids might, or they might need a place to live, and they're in their teens, so we don't really know. But if I sell this property, I may not be able to get back in to the market.
That's true.
So that's what I hear my clients when they're trying to debate whether to sell it or not. And then most of my counsel is around the timing of sale, before or after death. What are your other options, and what are the different tax consequences, to make an informed decision about what makes sense for that family and that property.
Taylor, what is the difference between an LLC and a trust? For those listeners you're throwing a bunch of names around and acronyms, what is the difference? And would you ever use an LLC over a trust, or a trust over an LLC?
An LLC is a limited liability company, and that is a type of business entity. And a business entity needs to have a legitimate business purpose. So if it's your primary residence, typically putting it in an LLC doesn't really make sense. But if it is a primary residence that's also a farm that has working capital and assets and employees and other things, and a limited liability company may make sense. So there, again, no one size fits all, but the LLC option is a business. And there are times when having a business that is in place right now makes a lot of sense for management and for economic ownership, which can be those two things, management and the money, we'll say, the value can be split. This could be an excellent tool for property that folks want to keep in the family that is rented, or maybe a family cabin, or something, a beach house that folks want to use on a regular basis, but don't necessarily want to, they want to keep it in the family. They don't necessarily need an outside property manager, but multiple people are using it. And we need some kind of management agreement, right? How is this going to all work? How is this going to flow? A limited liability company can be a neat tool to create that management structure, to define different roles and responsibilities, and to typically pick who is the mediator of the family and what are the terms on which you, next generation, and then your kids, and then your kids, and then your, what are we going to do with this, and how is that going to work, while also giving those different owners, whoever they are at that time, the ability to change an operating agreement by agreement, right? Or potentially make an agreement to sell the property. There's a lot of things you can plan for within a limited liability company. So it can be a really neat tool for certain types of properties. You can do similar things with certain types of trusts. And I'll back up here to say there are as many types of trusts as there are businesses, right? Saying I have a trust does not tell me a whole lot of information. Same with saying I have a business doesn't tell me a whole lot of information. What do you do? How are you taxed? Do you have employees? Are you publicly traded? Are you, I don't know if you say I run a business. It's like, okay, well, that's a piece of information. There's a lot more for me to understand what you do and how it works. Same with a trust. I have a trust. Well, most people are meaning a revocable living trust. And the point of a revocable living trust is to avoid probate. But there are tons of other types of trusts that have other purposes and other goals. Some are to save on taxes, and some are to, for example, manage property. So how do you split the management process and those economic rights? How do you do the same thing I was just talking about with a limited liability company? A trust may be another way to do that. It's a little different in how the trust is taxed, and it is also possible that you could set up a trust that only exists upon your death. So if you said, well, while I'm alive, I get to control it, and I want to be making these decisions, and you know what, I may adjust and just sell it because I feel like it, or I need the money, or I don't think they're going to get along and keep it anyway, so I'll take that burden off of them. Having a trust built into your estate plan may be a better way to go than a limited liability company, which is really setting something up right now. The trust is it's just another tool in the toolbox. And when do you use a trust for real property versus, and we're talking about this kind of management, continued ownership of real property, not probate avoidance, a trust versus a limited liability company, it's a complex choice. And part of it is, when do you want to pass the baton? Is it something that happens right now? Does it make sense to have that right now? And then there are additional questions if you're looking into the realm of limited liability company that is specifically about liability. Mm-hmm. Okay, so if I have a fourplex, I have more exposure to liability than I do a single family residence that's used as a cabin and nobody rents it, right? That's a very different liability. If you own an apartment complex, it's a whole nother scale of liability. Mm-hmm. And so a limited liability company is typically on its face to limit liability, to say you can't sue me past the value of these assets. Mm-hmm. And so that's a different question of, should I have an LLC for my rental properties? That's really different than what happens upon my death. Mm-hmm. And a different analysis. Those can be combined, of course. I've got this great rental property business running, or I've got 3 properties that make good income. How do I keep that going for my kids? those concepts are, we flow back and forth in these kinds of appointments on what do we do for a succession plan, but also what makes sense for you right now. And I would say that, again, not one size fits all. Having a really good umbrella policy is step number one. For any property you own, umbrella policy is going to be your first line of defense. And a limited liability company could be overkill if there's not a ton of exposure. And the more people who could sue you, the more likely a limited liability company will help.
Can you put your LLCs, let's say you are coming to Taylor and want to do your estate planning, and you already have LLCs, and you want to set up a trust, can the LLCs go into the trust?
Absolutely.
Okay.
They can and they should. And it doesn't stop the liability protection. Everything that's in the bucket of the LLC is going to be protected, assuming you've done all the things right to get that protection. And then the sort of umbrella is going to be the revocable living trust. And that's going to avoid probate for your company and for your other assets that are part of that trust. So it is not complicated to assign that, except to keep an eye out for provisions and restrictions on transfers if your LLC is owned with someone else. So if you're part of a company that is with, let's say, a family company where you're co-owning with your siblings and the parents set it up and you want to give it to your kids or your spouse, that's another trickier one.
Yeah.
You'd have to look at that original operating agreement and say, can I even do that? Can I give it to my spouse? Right? Because the operating agreement will have, most of them, some restriction on transfer saying, we can't admit other members. Or, and if you do, here's what happens. And so we just want to be thoughtful about making sure we've coordinated all the different governing documents, your estate planning and the business, to make it flow through. Now, if it's just you and your spouse who have the limited liability company for rental properties, that's much simpler because you're both there. You both want the same thing.
One of the things I do want to say is for any listeners out there, if you do pursue this route with Taylor or whoever, and you set up your LLCs, and I don't know on the trust, so you can fill in this part of it. One of the things that you have to remember is it's not one and done. You have to file every year. And if you don't file every year, you lose the LLC. Is that the same with the trust?
It's not the same with the trust, but people all the time have LLCs that have been administratively dissolved. And that's what you're talking about. You don't pay your fee, you get administratively dissolved, and you only have a couple of years to fix it. And then you have to pay all the fees that you missed to catch up. So it feels like a bigger hit than just having it done every year on the regular. And there are some really inexpensive companies that will help do it for you and send you the invoice. And there's also a lot of spam and fraud telling you that they are those independent companies who will pay your annual fee for you. If you just send them a check, for $150 instead of $100, they'll take care of it. Don't fall for it. They're getting really good. It looks just like the Secretary of State's renewal notice. Go straight to the Secretary of State's website and renew online. That is the safest way to do it. Or you can look at, I think there's even like myregisteredagent.com. I mean, and that's not a promotion. I don't know, but I know that it can be something that you can automate and you can have somebody else help chase you down to make sure you don't miss that filing requirement. The LLC being in the trust doesn't save you from that, doesn't change any of that. But a trust, when you set it up, it's a good idea to maintain your trust in the sense of keeping it updated as there are major life changes, but there's no annual filing fee. There's no, over state supervision in any way. That's a private document that you can, of course, I tell my clients, check in with me. I'd love to see you every 3 to 5 years. But I also recognize that most people just want to check this off their list and let the documents go collect dust on their shelf until something big happens. Right. And that's okay. And that's something that most people do. And that's not something you have to update if you have a trust every year.
Right. Well, just remember, so you can also file also for your clients who want you to file?
I can. Again, it's typically not cost effective. So I do have clients who say, can you please, file for me and be my registered agent? And we're willing to provide that service. I just always say you don't have to. And what we typically do is encourage folks to have at least an annual meeting. And we can talk about the cost benefit of that. But when you have an operating company, you want to be checking in on that. You want to be doing your due diligence. And this is the downside of a limited liability company, right? It is a company. It's a business. And you have to fulfill the requirements of being a business, including with the Secretary of State, but also essentially papering your file to say, yes, we treated this as this isn't just my right pocket versus my left pocket. That doesn't cut it for liability protection. This has to be treated as its own separate entity. So again, clients come to me and say, do I need a limited liability company? We've got this one rental property. And often I say, well, if you've got a good umbrella policy, that may be overkill for all the other work that you need to do to make sure that you get that additional liability protection. Or I don't think it's not something that you really want to do. If you have a number of different members, or you have a business, farm property, forestry, whatever it might be, you should be doing this anyway. Having at least an annual meeting to check in on the big picture things and documenting here are the officers of the company, the corporation or the members of the company, things like that. So again, there's no one magic bullet for all the situations, but I do think that our discussion here about limited liability companies, it should be something on the radar of property owners to consider whether there are some benefits for them and whether it would be enough benefit to make it worth the hassle.
Absolutely. I think that there are a lot of different scenarios on if I should do an LLC. How many properties do I need to own before I start considering starting to put them in LLCs? It's not just the filing and staying on top. It's also not commingling your funds. So setting up your bank accounts properly so each LLC has its own account. We have a property management company and we have a trust account for our clients' security deposits. It's just following all these laws. It's not to say you shouldn't do it, because I think that to protect yourself with an umbrella policy, and if you want some LLCs because you're starting to build your wealth, then it is something that you should speak to someone like Taylor or come to us, and then we can send you to the right people, whether it's an accountant or whoever you need. Those are all just really great options as you start to build wealth with real estate. And if you have it and you are getting older and you're looking at your trust and what kind of trust, which comes to another point. You said, there's so many trusts out there. Can you briefly go over some of the most popular? And then also, if you'd be so kind, tell us the definition between a revocable and an irrevocable trust.
Great question. Before I do that, I want to circle back to 2 points that come up before we leave the LLC piece. One is that having a property manager like you is an excellent option to make sure that you've got somebody else who's neutral and independent looking at how you're running a limited liability company. So I would really encourage folks who are dealing with rental properties. It's complicated out there. There's a lot of laws and there's a lot of rules to follow, not just on the liability side, but on evictions and tenancy and agreement. It just gets really complicated. So particularly for the Portland metro area, it's worth the cost. It may not seem like it necessarily at front because you go, oh, I could save this amount of money, but you don't know how much it costs when you do it wrong. And the numbers I see on the damage control are much higher than the numbers I see on the management cost. So it's somewhat of an invisible could be cost, but there's so many. It's a minefield, and I don't want someone to get blasted, if it could have been avoided. So that's one piece I wanted to highlight, that obviously you said you have a management side, and that's just a huge benefit for folks to consider. The other question I get a lot is, do I need multiple LLCs if I have multiple properties? Should every property be in its own LLC? Or can I put just one LLC that has my rental properties in it? And I just wanted to highlight that is a common question with no one, answer, but it's absolutely possible to have more than one property in a limited liability company. And the question is just about how much liability protection do you want versus administrative hassle. It goes right back to that question. So no, you don't have to put every single property in its own LLC, but we may want to evaluate whether you want to split them up. If you had an apartment complex, again, that just has a lot of liability there, a lot of different tenants, a lot of different functionality, a lot more things to track. That may be in its own LLC, but 1 or 2 or 3 single family residence rentals could be in a different LLC. Right. So you can structure it in a way that makes sense for the properties at hand. But there's no, yes, you have to have every property in an LLC, or yes, you have to have everything together. There's a lot of choices there.
So this is a great conversation when you sit down with your lawyer and accountant and try to decide which way you want to go. I think that's an excellent question.
And property manager.
And property manager.
Yes, exactly.
I like very clean and keeping all of our clients just legit out there, just having everything, nothing commingled, and just following the rules and regulations. And there are laws that change constantly, especially here in Portland, and especially with tenant advocacy regulations and laws that come in and out of play.
That's a really nice way to say that. For all the landlords out there who might be thinking a different way to describe the laws that are coming up. It's interesting. So your question was about different types of trusts, revocable versus irrevocable. And an irrevocable trust is one you cannot change. When there are different types of irrevocable trusts for different purposes, and there's a big distinction between trusts that are irrevocable but set up during your lifetime and trusts that are irrevocable but set up after you die. The question I would say there's sort of a quadrant here. There's revocable living trusts that are set up during your lifetime and you can change anything. That's your baseline foundational estate planning document to avoid probate. Okay, and probate, we covered this a little bit last time, but probate is just court supervision of transferring your assets after you die. Your will is irrevocable at that time too. And if you don't have a will, it's subject to probate, and Oregon or Washington or the state you live in has a plan for you. So probate is whether you have a will or not, but if you want to get out of the court's purview, typically you have a revocable living trust. Upon your death, that revocable living trust could still be called, technically the name of it might say revocable, but it's now irrevocable. Somebody else can't come in and change your plan, just like your will. So that's a big piece of information, right? When does it might be a little bit confusing, but it's not revocable after you've died. There are some joint trusts out there who tie the hands of the surviving spouse and make it irrevocable upon the death of the first spouse. That's something to look for. There are reasons people do that on purpose, and there are reasons people do that on accident. And it's a mess if it's on accident, and sometimes it's frustrating. It just should be a thoughtful decision if it's on purpose. So I'll just put that out there. If you have especially an old joint trust, have somebody take a look at it, because you can fix it now while 2 people are alive. It gets really nasty and expensive after that, especially with non-joint kids. So just asterisk. So revocable living trust becomes irrevocable upon death, and pretty much anything that's set up to take place after your death is generally irrevocable. There are ways to work through an irrevocable trust if it doesn't make sense anymore. Typically, if everybody agrees by a non-judicial settlement agreement, there are also ways to get court approval for a change to the trust, but it has to still fit with the general purpose of the trust. There are restrictions. You can't just make it say what you want it to say. So there's a lot more that your hands are tied with. Okay. The questions I get are in the category of what do I do during my life? And I think that's where you were going is, well, what about an irrevocable trust I set up right now? That, to me, is a tool to fix a specific situation. It's not just everybody needs an XYZ. If you have a revocable living trust, that's the baseline. And if there is a specific concern or a specific asset that you want to address and typically reduce the taxes on, then you set up a special type of irrevocable trust for that asset. One of my favorite tools is called an irrevocable life insurance trust, also known as an ILIT. And what that does is put your life insurance policy outside of your taxable estate. So think about it. If you have a life insurance policy with a $1 million death benefit, that $1 million does not feel like cash to you, right? You're not actually giving up a whole lot if you were to lock that away and not, quote unquote, have it available to you, right? It doesn't feel like it's something that you're dependent on. But upon your death, to pay, minimum of $100,000 in taxes in Oregon, right? Minimum of 10% on $1 million. That seems like a big cost when all you're trying to do is maybe get some more liquidity into your estate because you're mostly property heavy, or you just want more money for your kids. You've been paying into it for so long. Whatever the reason is, an ILET can be a solution. Now, there are complexities and you have to do certain things. You have to give notice to beneficiaries. Typically, there's annual letters. You can't easily, anyway, it's irrevocable. If you set up an ILET with all 3 kids as the beneficiaries of that policy owned by that type of irrevocable trust, and then you have a falling out with one, and you say, well, I don't want them to get anything. It's going to take some fancy footwork to undo that. It's not impossible, but it's supposed to be. And anything you do may cause estate tax inclusion. So you have to tread carefully, and I don't race to do these irrevocable instruments unless there's a good reason. And sometimes there's a really good reason and really solid family dynamic, and it makes total sense. Sometimes it's to get a better estate tax result through charitable deductions and things like that. So there's a lot of types of charitable trusts out there where there's certain benefits to individuals for a set period of time or for their lifetimes, but then everything goes to charity. And that also, almost all of it is, I have this goal. I don't want to pay as much in taxes. I have these assets. What else can I do? And all of those irrevocable trusts for your lifetime come with strings attached. They come with costs and they come with lack of control. And that is or they come with some other risk, right? And that is always, for me, the analysis of asking those questions, is it worth it? And sometimes it's a very clear yes. And often it's I don't really like giving up control. I'll just move to California and not have to deal with that. I've got a situation right now. It's so unfortunate where the clients during their lifetime set up a estate plan really based on Oregon estate taxes. And I won't go into the details here as far as client privacy and all that kind of stuff. But the long and short of it is that the estate planning attorney was making some assumptions about where all this money came from. And the first assumption was that it came from the husband. And there's gender assumptions on everything, right? So I don't mean to harp on this person, but that was the assumption. And so on the death of the husband, a lot of that wealth was locked away. They had separate kids, so it was to protect the husband's assets to make sure his kids don't get upset, right? Or that their rights aren't going to be affected. So then a surviving spouse comes to me and says, I didn't actually get along terribly well with that attorney. Can I work with you instead? And we look at the documents and I say, well, sure, but your hands are pretty tied on this. And she goes, what do you mean? It's my money. And I said, tell me more. And she said, all of that was what I earned. We had a later in life marriage. I brought all of that to the marriage. What do you mean I can't just sell it? And I'm moving to Arizona. I don't need to worry about Oregon estate taxes if it all came to me. And because she had owned multiple properties and multiple LLCs in 12 different states, and because of the way that this was divided between an irrevocable trust and this business interest was divided between her now deceased husband's irrevocable trust and her revocable trust, she is filing no less than 26 income tax returns every year. So her accountant fees went through the roof. And if she had just gotten her own stuff back and moved to Arizona, she could just do what she wants to do. Those are the kinds of things that it's like, oh, that wasn't intended. That wasn't on purpose. That was making assumptions about what's going to happen in the future. And the assumptions were reasonable and not way out of the ballpark, but turns out they were wrong, only in hindsight. And now this client is very unhappy. It's hard because we can't predict the future. And so I don't mean to say that I want to mitigate taxes. Absolutely, that's part of my job. But I would say that it's situations like that that make me want more flexibility for my clients, want to have more assurance and certainty about what their future might hold. And the older they get, the more aggressive I feel comfortable being on things that are solely for the purpose of avoiding taxes. but most of those irrevocable trusts are for a strategic tax purpose and not necessarily where I would say most listeners need to start.
Which was going to bring me to my next question. What is the biggest piece of advice that you would give a young couple, newly married, maybe they own their first home? What is the one thing they should absolutely have? I have my idea. I'd love to hear what you say. And then also for our folks that are kids are grown, they have their home. What is the biggest thing that you think they should have put in place?
I would say the single most important bang for your buck is a power of attorney. Okay. Hands down, absolutely, no questions asked. A power of attorney naming people that you trust is going to save thousands and thousands and thousands of dollars and hassle and stress. And it goes on how the laws are changing. You called it tenant advocacy. We'll call it advocacy of people who can't speak for themselves, incapacitated folks. Yes. It's nonsensical at some point, right? Where it becomes so cost prohibitive to help someone. The intent is good. I don't disagree with the intent. The policymakers are trying to do their best. I get that. I'm not at that table. I can't criticize that aspect. But the effect I see is a lot of money and a lot of stress and a lot of negative outcomes. So financial abuse is rampant. That's real. I get it. That's what they're reacting to. And if you have anybody you trust, get a power of attorney in place. It's simple. All you do is pick that person. Trust is key. They should be a good person who's not going to steal your money and financially abuse you. Don't pick that person. Don't put your child on there just because they're your child. If they've stolen money from you, they will again. I promise. I mean, it's just not, it's not about who's entitled or who thinks they should be. It's about who you trust. And a power of attorney, hands down, but especially if you are over 60, even over 55, maybe, is when it's like, gosh, there's just so much unknown, and our medical advances are allowing people to live longer, but at what state of capacity? That's just a big question, and it's really hard. So Advance Directive, put a plug for that one. It's free. You can download it. Google Oregon Advance Directive. Everybody should have one. Do not need an attorney to do it. And healthcare decisions is the other piece of incapacity planning that's critical. And so the young couple, I would say if they don't have kids, then they have different heirs at law. Okay, so that means that they need a will at baseline. It could be an incredibly simple will that says if we both die, who gets it? Right? Or on the death of both of us, who gets it? Because it turns into a race to live situation. And that's a really hard thing between the families. If you do have kids, then a will with a trust for the kids is critical. It goes back to the reason for the power of attorney being so important, that if you don't have a trust for your children, then the court gets involved and supervises all the money that goes to them. And the long and short of it is it ties it up until they're 18. And on their 18th birthday, they just get it all. There's no continued management.
Even if you have a will that is written to sort of discuss different milestones?
If you have a will that sets up a trust, so you can have a trust created by a will, and that's one of those trusts that comes after you die. So yes, you don't have to go for a revocable living trust if you're young and just getting started and you just want to keep the costs low. We can do very, very simple terms of your children's trust within a will, but set all that up. But here's the thing that people do. They do a will or a trust, and they set up a trust for kids. And then they go and they set up, they get a new job and they are eligible for the 401k. And the HR person says, all right, well, who are your beneficiaries? Your spouse first and then your kids, right? And they go, yeah, of course, that sounds right. And if they die, and it goes to the kids, it's going to skip the trust. It's going to go straight to the kids and be subject to conservatorship, court supervision. So don't defeat your own estate plan, is my point. And people do this all the time with lack of knowledge, even if they've worked with an estate planning attorney who just didn't hammer it home, or if they just forgot. There's a lot of information to process. It's a very human thing to do. It feels very natural. So to the extent I could hammer it home, don't defeat your own plan. If you've gone through the effort to have a trust for your kids, then make sure everything goes, it sounds odd, but everything goes to probate. if it's a will, right? You want it to go through probate because you want it to follow the terms of your will to flow down to the trust for your kids. And are there ways to name the trust as a beneficiary? Sure. It gets more complicated. We can work through those questions. But the long and short of it is, if you don't have kids, a very simple will to say what happens when you die for both of you can make all the difference in the world. And if you do have kids, a very simple will that otherwise, has a trust for kids, and we can just say health, education, maintenance support until they're 30. And that's going to still be wildly better than going to conservatorship. What were you going to say? I'm curious.
Like if you're a young couple, and because we hear a lot of young couples, they're buying their first house, they may be ready or have their first child, and a lot of our clients don't have wills. And so for me, I always think you have a child involved. There's you really want to have directives so that it's not who gets the child if something happens to you. I mean, these things that all of a sudden you have to start adulting on and making these decisions. So that was absolutely. But I didn't think of the power of attorney. I was sort of thinking, trust, but power of attorney, yes. Any the health directive, very, very important in my mind for anyone who has parents that are getting up there, and health directive, perfect. And DNR, if they want that. I mean, make sure these answers to their thoughts of what they want, because you don't want to be making them at that moment. Yeah. And you want to protect.
Easy. Right. And it's not easy to talk about any of these things. And that's why having someone like Taylor actually just puts a buffer between it. And you make it all sound so normal and regular. And this is what you talk about all the time. It doesn't sound like a scary thing. It doesn't evoke like fear and, death. It actually makes me feel so much better knowing you're out there doing these things for people. You can just live your life and you've got all your insurances in place, basically. That's the way it should be.
Exactly right. Estate planning is like an insurance policy. And if you think of it that way, it's one of the cheapest ones out there. Yeah. And I will say that not just any estate plan and not just any will. Okay. I just want to put a little asterisk there. Again, it does not have to be me, but please don't just sign up for whatever attorney is available, or criminal defense attorney who quote unquote does wills for cheap, or a LegalZoom, or a, Quicken My Will, whatever it is. Oregon has incredibly strict formalities of execution, and it is much more expensive to fix those things that are done incorrectly. And just because somebody's an attorney doesn't mean they do this. Doesn't mean that they actually work with this area. And a lot of people in my world, a lot of colleagues who I have a lot of respect for in their practices, think that wills are just something they can add on to their practice. It's just it's just a form. I've got a form. And they don't give all this other, well, what about your beneficiaries and how do you defeat your own estate plan? Because they don't know it either. It's tricky. I understand the do-it-yourself temptation. I certainly understand the cost, aspect of it. That is absolutely a factor. And if you calculate in the cost of fixing it, it goes back to the same analysis as having you guys as the property managers. It's like, what is the cost of damage control? And from my experience, there's just a lot of attorneys out there who don't actually know what they're doing. And they're not going to be the ones to tell you that. So check their website. First and foremost, do they have one? They should. It's just part of the deal these days. You got to have a website. It doesn't have to be that complicated. On that website, does it say, I do criminal defense, and I do landlord-tenant, and I do real property transactions, and I work with businesses, and I can do estate planning? No, that's too much. Mm-hmm. You can't be that good at all those different things. So they probably do a little bit of everything, and they're probably good about some things that maybe don't have so much risk. But the thing about estate planning is you don't know it's wrong until it's too late to fix it.
So true.
So same with property management.
Yes.
You don't know until it might be too late, but at least you'd be alive.
And well, this was great. I mean, we could keep going. It's been wonderful. Taylor, you are a wealth of information, and I always enjoy talking to you. And it's complicated, and but good lawyers.
But
as
it's not
Taylor said.
it's not impossible though.
Exactly. There's more here. Don't do it yourself. Ask a question. Find an attorney that makes sense for you, and it's something that is more achievable. It's something that's not as, you don't have to have all the answers. You just have to know who to ask, and you don't have to memorize or understand everything we talked about today. You just have to know who to ask, and that you have somebody you can trust who's going to have your back and do your documents right. And I really appreciated the chance to be here and to talk with you both. And I appreciate that you guys can be advocates for getting people the things that they need, because it's just planting seeds and making sure that I wish this information could be more often shouted from the rooftops, and that we could be more comfortable talking about it. And I appreciate you taking this one step towards that end.
Absolutely. Tell people how they can get a hold of you.
Again, Taylor Cattell, and I'm with Breakwater Law, and you can find our contact information at breakwater-law.com. Our phone number is 503-878-8948.
Okay. All of Taylor's information and Audra's information will be on the show notes on the webpage there.
Yes.
Well, ladies, thank you so much, and we'll be talking to you soon.
Thank you for everything. I really appreciate being on here.
I love it. Thank you.
Thanks for listening to the Portland is Home Team Talking Real Estate podcast. For more info about Audra and Andrew, finding your next home, or selling your current home, visit their RealtyWorks website at realtyworksgroup.com. And check them out on Instagram at Portland is Home. Be sure to subscribe on Apple, Spotify, Google, or wherever you get your podcasts. For help with your podcast, find us at Modcast Productions or modcastproductions.com.